Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets and comments on record highs for the Dow and the S&P 500. He also chips in on oil and the Canadian dollar. Author of The Money Bubble, John Rubino, tells us both left-wing Democrats and President Trump want the same thing when it comes to the U.S. dollar. They'd like to see it go lower. He discusses what that could mean. WolfStreet.com publisher Wolf Richter wades in on interest rates, new and used car sales. It seems no one wants a small, fuel-efficient vehicle these days. Plus, at the end of the show, we'll have company showcase updates from American Manganese CEO Larry Reaugh, Naturally Splendid co-founder Craig Goodwin, and Abbott Resources President Jim Pettit. We'll talk to Ross Clark right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
It's good to be with you, Jim.
Ross, I know we're in holiday season right now, but it doesn't seem like there's much of a holiday on the major markets with records, it seems, being set every week.
No. The sellers are on holiday. You see, the buyers never took time off. The buyers can take time off sometime out in August, September, and that's when the sellers come back from their holidays. But now, as you say, record highs. S&P, the Dow, NASDAQ just barreling along big time. Even, it's interesting, even the transports, which have been having a pretty tough time of it the last year and a half, they're starting to see a bit of life here as well. They had one of their better weeks. I think it was even on Friday, about a 2% day. So a little bit of catch up there. We're going to be watching pretty closely here to see how, as we've moved into new highs, that the transports do manage to continue to step up, because a Dow theory sell signal can kick in pretty easily. So if we get a little bit of just a pause and then market goes up to a higher high, but the transports don't agree with it, that would be a precursor to a better correction on the downside. So we're putting that in the back of our minds as a potential item. And when the trend's up, you want to enjoy it, but you always want to be more and more cautious the further along it gets in the move. And I think we're the better part of 5 weeks in this run right now. So getting a little bit stretched out.
Now, what's behind this? Is it that the U.S. Fed is expected at some point to drop interest rates?
Oh, yeah. I mean, it's the Powell put, it's the Fed put, where you've got the quarter point rate move now is pretty much factored in, especially after Powell was before Congress this week and with his testimony. But the 50-point break this in the near future, that one has really gone to the back burner. It's not expected at all. So what you now have is that where we were really overextended in the long bond, the 10, 20, and 30-year bonds, which had just a phenomenal move, they had good, strong sell signals in the last week or so, going into a week ago, and reversed early in the week, and then as Powell's comments came along, clearly they took it on the nose. So the 30-year yield, if we look at it this week, went from 247 up to 266. That's a pretty big jump. The 10-year went from a 194 yield up to 215. And yet on the front end of the curve, if you're looking at the 3-month T-bills, they dropped from 220 back down to 209. So you're starting to see, for all that we were getting that flattening yield curve where the long end was narrowing down relative to the front end. That has now started to steepen a little bit. And if this steepening continues and to move through its support area, then you can start to see some weakness being factored over to the equity markets. For now, it's probably, if we were looking at it on a scale of 1 to 10 in terms of how developed this process is, we're probably out at about an 8 or 9 right now. It's not going to take too much more on the spreads to kick in some warnings for equities. So that's, as I say, that's another item that we have out there to concern ourselves.
Oil, how's it doing? We have storms brewing in the Gulf of Mexico and perhaps some kind of shooting thing brewing out in the Middle East.
Yeah, and we had our overall perspective here is that this 10-year cycle has got another year and a bit here as far as this up phase is concerned. It started from last December. So the correction back to $51, $52 that happened into June got a really good bounce off the bottom up to 60, has had a bit of a pause, and this is exactly the scenario that we should be working with here on the technicals, that from here through the end of the year, it's just going to stair-step its way up. So in this last week, we'd been up to 60, we backed off to $56, and then rallied back just over 60 at the tail end of the week. So you're starting to see that stepping up function. So I would suspect here that as long as we hold 56 on any minor corrections in the next month or two, that we will continue to work our way higher. And the norm is that by the time we get out into next year, we should be well through that $76 print that happened back in September, October of last year. So bias is there to the upside, but the pace of the advance that we had off that original oversold low in June should be subsiding.
Is that good news for the Canadian dollar?
Well, Canadian tends to move with oil and with the general commodity index. So if you look at the DBC or the DBA, which would be your commodity indices, they had a pretty good week this week, and that's supportive to the Canadian. Although, and we are thinking that the Canadian, if it's going to move together with these commodity indices, it should have upside bias to the end of the year. But I would really, really like to see it pull back. We are at 76, 72 to close off the week, marginally higher than the last, 5 or maybe 10 or 15 days here of trading. So it's a small breakout on the chart. But what you really want to look for on the Canadian is a good solid setback of 2 to 3 weeks to provide what I would suggest would be the next really good buying opportunity. But not looking for exceptional move on the Canadian dollar on the upside. So if you get a correction back into the 75 to 76 range, maybe you're looking at a 78 to 80 at the tail end of the year at the best.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, John Rubino next on This Week in Money.
Always consult your investment professional before making any investment decision.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. I'm speaking with John Rubino, author of several books on the economy, including The Money Bubble, his website dollarcollapse.com, John, welcome back to This Week in Money.
Hey, Jim. Good to talk to you again.
The S&P 500 hit new all-time highs this past week. We've heard predictions of 40 to 50,000 on the Dow. What are your thoughts?
Well, I think that when you create a lot of new currency by pushing down interest rates or by running a quantitative easing program or whatever, that money has to go somewhere. So the question becomes, where does it go? And it's looking like U.S. blue chip stocks are viewed by the world as a safe haven asset, right? If you get a negative yield in your German bond, why not just buy Google stock instead? Because Google has pricing power, it's global, maybe it goes up in value, and your German bond isn't going to go up in value because it already doesn't yield anything. It's already costing you money to own it. So money is flowing into U.S. stocks. Now, at the same time, valuations here are historically off the charts. Stocks are as expensive as they've ever been in terms of earnings, and earnings in the U.S. are flat to declining for most major sectors. So leaving aside monetary policy, you would look at the stock market and say, oh my God, this is a crash waiting to happen. The valuations are where they were in 2000 and look what happened. And corporate earnings are falling. You never have rising stock prices when corporate earnings are falling at the peak of a cycle. That never happened. So stocks have to tank from here. But you got the monetary policy thing, which is a very real thing. So there's no way to know. It's important to understand what it means, for instance, when asset prices go way up like this. It's not that they're becoming more valuable. It's that the currency in which you're measuring those things is becoming less valuable. So what we're seeing is selective devaluations around the world. The U.S. dollar is becoming much less valuable relative to stocks and relative to gold, and still in the U.S. real estate. Our house prices are still going up. In fact, I'm selling a house into an insanely strong real estate market in Idaho right now. It's just numbers that don't seem to make any sense for the surroundings, but that's the way it is. And that's because the dollar is going down relative to northern Idaho real estate. And that it happens selectively at first is not that big of a surprise, because inflation is very seldom an across-the-board thing. It usually manifests in niches to begin with. And then, if it's not short-circuited by higher interest rates, it spreads to the rest of the economy. So we're looking at the early stages of Austrian School of Economics crack-up boom, where people just figure out that the dollar is, by explicit government policy, going to go down in value. As far as the eye can see, and they just bail on the currency. Instead of just buying stocks or just buying gold or just buying a house, they buy whatever they can get their hands on with whatever money comes their way, because they don't trust the money anymore. It's not that they're excited about what they're buying like people are with stocks right now. It's that they're the opposite of excited by the money that they have in their bank account or their wallet. And at that point, the currency basically dies. So that's our future. That's what we're headed for. And it's just a question of which asset classes are singled out for inflation along the way before it becomes a general thing. And U.S. stocks could be something that we continue to see as a safe haven asset for a while, and because of that, it attracts a lot of hot money. And stocks could go up to valuation levels that don't make any sense even by today's standards before the bubble finally pops and they tank. See, I think gold is driven by that same dynamic, but gold is nowhere near bubble levels yet. So, and silver is even more so. It's even more cheap relative to its history and to its supply and demand dynamic. So I think they're a much safer bet at this point, but that they're also driven by the same dynamic. As we pump more money into the system, some of it goes into safe haven assets like gold and silver. So they will tend to go up in dollar terms, but in a safer way. A lot of stocks could drop by 80%. They dropped by 90% after the tech stock bubble. There was a 90% club, of stocks that were down that much. And that could easily happen again in equities if corporate earnings are perceived to be headed down from here. But with gold and silver, you really don't have that kind of a valuation issue because they're really cheap compared to the amount of them in the world and the ongoing increase in their supply. So you could easily see gold and silver go up 5 or 10 times from here. But stocks going up 5 or 10 times from here would just be outrageous. That's inconceivable even in a budding hyperinflation. So I think it's a lot safer bet if you're looking for places to hide out in precious metals rather than Amazon stock or something like that.
John, it seems strange to you that something's going on in the U.S. that you wouldn't expect with Alexandria Ocasio-Cortez agreeing with something that President Trump wants?
Yeah, normally those two don't agree on much of anything, and they certainly don't like each other, but their monetary policies are converging on easy money forever. Right now, for the past few months, Trump has been bullying the Federal Reserve to lower interest rates, and it's now being reported that he's been asking his aides to figure out a way to devalue the dollar, which is basically another version of easy money. Ocasio-Cortez, meanwhile, in the most recent congressional hearings in which the chairman of the Federal Reserve, Jerome Powell, came to speak, she pointed out that it used to be thought that 5% or so unemployment was as low as it can go before inflation starts to ignite and we have to raise interest rates. But we've got unemployment all the way down to 3.7% now on the official headline number, and there's still no inflation. So her question was, why can't we continue to lower interest rates if lower unemployment doesn't hurt or doesn't cause inflation? And the chairman of the Fed said, maybe that's true. He kind of agreed with her, that we can go much lower in terms of unemployment than we thought we could in the past. So now you got both the left and the right agreeing that we need interest rates to go down and probably that we need more exotic forms of quantitative easing going forward. And we need to weaken the dollar, which is all, they're all part of the same policy mix, which is under the umbrella of extremely easy money. And so now we're going to see this happen because both the left and the right agree on it, which means we'll see 0 and possibly negative interest rates in the next couple of years. We'll see new versions of quantitative easing in which they buy maybe not just bonds or high-grade bonds, but junk bonds or equities or maybe even real estate. Who knows? Now, this is extremely wrong-headed, but it's also inevitable and not surprising because when a society borrows more money than it can ever hope to pay off, like we have in the U.S., the only option to avoid another Great Depression becomes devaluing the currencies. And, this has happened dozens of times in human history when countries take on too much debt and they devalue their currency. We're doing it globally now. It's not just the U.S., but pretty much everybody is doing this. So we're entering a time that's both familiar in the sense that currency values are going to start to fall, inflation's going to start to spike, and we're going to get all the attendant chaos at the national level. But since we're doing it globally, we'll inevitably have some new things come along, where in the past it used to be one country screwing up their currency in the context of a sound money world. Now everybody's doing it in a fiat currency world. It's not clear what that means in terms of timing, but it's probably clear what it means in terms of fiat currency values and asset values when measured within fiat currency regimes and things like that. It's going to be extremely chaotic. It's going to manifest as inflation, but what it'll really be is a loss of faith in these fiat currencies. So we'll see their value plunge, and anybody who's not buying gold heading into something like this is probably missing an opportunity to protect themselves and maybe make a lot of money, because historically precious metals do really well in times when governments are acting this crazy.
Well, gold prices have gone up. Do you expect them to really fly then if this is what happens?
Well, nobody knows what's going to happen in the next 6 months or 2 weeks, but in the longer term, the policies that are now in place and the ones that are coming down the pipeline are all phenomenally good for inflation hedges and safe haven assets. So you want to be in real stuff when paper is being aggressively devalued by explicit government policy. And since it really doesn't matter who gets elected next time around in the U.S. in 2020, since both sides agree that we're going to have extremely easy money going forward, I think that's as close to a lock as anything is in the financial world. In other words, it's probably going to happen because everybody wants it to happen, and there's really virtually nobody out there who doesn't want it to happen and who will stand in the way of it. So it's coming. And historically, you've got a lot of good examples of what happens when policies like this are put in place. So we've got a pretty decent investment thesis here, one that says move from financial assets into real assets. And those things will help you weather the storm because they'll go up in fiat currency terms when fiat currencies are plunging. So I'm more comfortable about the intermediate term future in terms of what seems to be happening than I have been in quite a while.
With currency wars, everybody seems to be on a race to zero. What happens when nobody's currency is worth anything?
Well, then we go back to other kinds of money, because you need money, right? Money is not this made-up thing that's a shared hallucination. Then we can use anything for money. You know, we can use bricks or seashells or classic cars. Money is a tool, and certain things do a better job of being money than other things. You know, if you're building a house, you can pound nails with your shoe or your forehead or a rock that you find in the road, but a really good hammer will do a better job and build a better house. And gold and silver have historically been extremely good forms of money because they do the things, or they have the characteristics that are required for a good form of money in the sense that they're fairly rare and the supply of them grows at a stable pace, 1 or 2% a year. So they tend to hold their value. Unlike fiat currencies that can be created in unlimited quantities, in unlimited, in varying timeframes by government. And therefore they tend to lose their value. So we'll go back to some other kind of money when the current kinds of money don't work anymore. When today's currencies fail, we got to find something to do that job, and we'll probably go back to some kind of a gold standard. So that's what will happen, and we'll have to do it at a much higher price of gold in terms of fiat currencies. So the guys who've run the numbers to calculate what price of gold would be required to back the world's fiat currencies get $10,000 per ounce and above in terms of U.S. dollars, because you need gold to become much more valuable with its limited supply in order to back the amount of currency that's outstanding. So to get from here to there, then the price of gold has to go way up. And if you own it, you make money in local currency terms.
With Japan and Europe either having negative interest rates or very close to them, how are their economies working out, and how do they expect negative to help out at all?
Well, two things. One is Japan and most of Europe have borrowed way too much money, and that's inherently deflationary, because if you're paying interest or you've already got a huge amount of debt and can't take on much more just mathematically, you don't get to spend as much on other things, and that translates into lower growth. And that's what Germany and Japan are both seeing. Both of their numbers are weaker lately in a disturbing way. Germany is barely growing, and they're basically the engine of growth for the rest of Europe, because they're really the only successful economy almost in Europe or in the EU. And if they're not growing quickly, nobody else is either. So they're under pressure to lower interest rates from here. And the dominant economic theory in, most of the developed world is Keynesianism, which says that debt is basically a good thing, because when you borrow money, you spend that money, and it increases what they call aggregate demand. In other words, the amount of stuff we buy goes up. And that's really all they look at. They don't look at how much we had to borrow to get this and what the effect of negative interest rates are on other parts of the world, and they don't look at any of that. They just look at how much we bought this year. So in their mind, if you cut interest rates, people borrow more money, they spend it, and that's basically all you need to know. So they think that lower interest rates will improve the near-term economy. And in normal times, that's true, because if they convince you to build your dream house because they're lending you money at negative 1%, lots of people get paid when that happens. And in the short run, that's better for the economy. But that debt that has to be taken on to generate all that spending causes trouble in the future until it becomes debilitating. It gets bigger and bigger and more onerous, and then it becomes disastrous. And we're heading for the time when what slows us down today basically destroys us financially tomorrow. So the guys who are advocating for lower interest rates from here and higher government spending and more quantitative easing are right in the very, very short run and disastrously wrong in the longer run. And so we're heading into their longer term now. As Keynes used to say, in the long term, we're all dead. So in other words, don't worry about it. Just fix the problems that are in front of us and don't worry about the long-term effects. Well, we're living in Keynes's long term now. And we'll soon be living in the long term of the guys making today's policy decisions. And it's going to be a very messy long term. When that becomes the present, our present is going to be really hard and really scary for most people.
With negative interest rates, there's no encouragement at all to save money, is there?
None. No. And which to Keynesians is good, because saved money is money taken out of the system. It doesn't become aggregate demand because we don't spend it by definition. And so it doesn't really exist from their point of view. A more realistic and more accurate economic theory would say that saved money is where investment capital comes from. In other words, we invest our savings in productive uses, in productive projects, and that's how a capitalist economy grows. And you take that away, and negative interest rates, first of all, takes away the price signaling mechanism of the markets. Because interest rates are the cost of credit, and if you do away with the cost of credit, then all kinds of crazy things happen. And if you eliminate the incentive to save, then you don't have prudent investment capital available for productive investment. So you get massive misallocations of capital with people borrowing at negative rates just because they can, and then they have to do something with it, but what they do with it is probably going to be stupid and not generate cash flow. So we're creating the conditions in which this financial system breaks down and literally ceases to function. And when that happens, if you're dependent on the functioning of this financial system for your well-being, then you are out of luck. So we can't stop this from happening because the political system has a momentum of its own that is being driven by the financial system. So all we can do is protect ourselves and our families to the extent that we can by not being dependent on the workings of today's financial system. And you do that with real assets. If you own a well-chosen piece of rental property, for instance, or some farmland in a climatically stable place, or gold and silver, then you're probably going to come through this in reasonably good shape because the value of the stuff that you own will go up in local currency terms. And so you'll be protected, and you'll have things that have utility in the moment anyhow. So that's really all you can do. I mean, there's very little you can do to change the macro environment right now because, as I said, the entire political system, right, left, and center, is all heading in the same direction in terms of monetary policy. And it's a really bad direction.
We'll have more with John Rubino when This Week in Money returns.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI, and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Rubino. John, does the Canadian dollar tend to have an inverse relationship with the U.S. dollar?
Well, we have different economies. The U.S. is extremely diversified, but also really financialized, which means we tend to do really well, when the stock market is up and the banks are doing well and everything. And you guys have more of a commodities-based economy, resource-based. And that means you do well when oil is up and timber prices are really high and to an extent gold and silver are really high. So what's happening right now is probably good for both of those kinds of economies because we're in the U.S. back to easing again and back to putting more money in the financial system, or at least there's the prospect that more newly created currency is going to be pumped into the financial system. So stocks are way up. The banks are basically reporting okay numbers and everything, and that's good for us. But at the same time, some commodities are going up too. Oil is up lately, and gold and silver are going up. So your mining companies are doing pretty well. And I don't know what your real estate markets are like there. I know you've had massive bubbles in the last few years, but I don't know if Toronto and Vancouver are still rising.
Oh, no. Vancouver and Toronto are plummeting.
Oh, okay. All right. So
the bubbles have burst.
Yeah, so you're like the canary in the coal mine then for the deflationary forces that are at work in the world. And we'll see what happens when governments respond to the deflationary forces that are derived from taking on too much debt in the past with inflationary policies. So it's hard to say. It might be great for a resource-based economy to have rising inflation and negative interest rates, like we're all headed for. But the instability that results from that really isn't good for anybody in the long run. I can safely say that both the U.S. and Canada will be positively correlated in terms of the crisis that's coming. It's going to hurt us both, and neither of us is going to come through it without a lot of pain for a lot of people. But we might have periods of divergence along the way that make it look like one or the other of us is well managed, but nobody's well managed in the developed world. We're all making huge mistakes. We're all taking on way too much debt. And your real estate markets of the past few years are kind of a good example of that. You guys had massive bubbles in at least your major markets. And now apparently those bubbles are bursting. So you're finding out what the downside of a financial bubble is. It's great while it's happening if you're the owner of the assets that are in that bubble. But then if you hang on too long, you don't feel smart anymore. And you definitely aren't as rich as you used to be. And that's, I guess, what's happening in Canadian real estate. It's possible that some of the resource markets will do well to offset that, but who knows? It's the specifics of what's coming, like I said, are really hard to predict because we're doing it globally now instead of locally. If it was just one of our countries screwing up in these historically common ways, then it would be easy to predict. But now with the whole world doing it, there's just really no way to know what the race to the bottom among the fiat currencies is going to look like exactly.
Is Canada's economy likely in recession?
Well, if your real estate market tanks, it's hard to stay out of a recession because real estate, in a financialized world like ours, real estate is this huge deal for so many people because governments lower, in order to keep the financial system going when it's taken on too much debt, governments cut interest rates to unrealistically low levels. That leads people to buy the biggest house possible with the biggest mortgage possible because the money is so cheap. And then when the value of that house falls, you've got a declining leveraged asset that can ruin your life. And presumably there are a lot of people in Toronto and Vancouver who are in that boat now. And when that happens, they don't buy as much going forward, because if the value of your house is plunging and you financed it, you financed 90% of the purchase price, then you're not going to take a extravagant vacation this year, right? And you're not going to go out and buy a brand new $70,000 SUV or anything, just because you don't feel like you've got that kind of money, because your house just dropped in value by $27,000 last year, and it's looking like it's going to drop by more than that this year. And that's the kind of thing that leads to recessions. So I don't know if Canada's in recession or not, but I think a bursting real estate bubble increases the odds of a possibly dramatic slowdown.
We have a provincial NDP government, which is a left-leaning government, that's bragging that they have helped bring house prices down drastically with a 20% foreign buyer tax, a 3% tax on homes worth more than $3 million, and a significant tax on vacant homes. Have you ever heard of a government bragging about decreasing one's home equity?
Well, especially in Vancouver, you had kind of a unique situation, because you had Chinese money just pouring in. And they were using Vancouver real estate as a store of value, not as a place to live, and not as a speculation on higher prices in the future. They just wanted to park their money in a condo, and they could leave the condo empty. They just needed their money over there, over in Vancouver rather than in Beijing. And that distorted your real estate market in a lot of really bad ways for the locals, right? Because nobody could live where they worked anymore if they work in Vancouver because of all that money pouring in. So it's understandable that the government took steps to try to stop that hot money inflow. But it's not a pain-free process when you do something like that, because you affect all the people who are current real estate owners if you push down the price of real estate. It's good for prospective buyers in the future, but it's not good for the people who bought in the last few years. Now, to the extent that a lot of those guys are living in Asia somewhere, it's less of a big deal. And, in a way, you kind of export deflation when you do something like that, because that makes the rich Chinese people feel less rich, right? And maybe they spend less. And China then suffers the pain of that policy. But there's no way to do this in a pain-free way. You see that in the developing world all the time, where hot money inflows destabilize the economy on both the way up and the way down. And there's nothing they can do about it, because they're not big enough to control or manage global speculative capital. If you're Colombia or Brazil or somebody like that, you're kind of at their mercy. There's not really much you can do. And Canada got a little taste of that just lately. Your economy is much more stable, and you have more tools than a developing country would have. But still, that's a lot of money coming in. China is just an immense place with millions of new millionaires and thousands of new billionaires. So if they want to move their money overseas, they can destabilize pretty much anybody. And Vancouver, and to an extent Toronto, got a little taste of what that's like. And hopefully it ends up not being excruciatingly painful, but it can't not be painful to try to manage this kind of stuff, because those numbers are just so huge.
Are President Trump's tariffs crushing China's economy?
Well, he kind of hopes that they do, so that China cuts a deal. But I would say that it's likely that China's problems, and they do have problems, they just have to bail out a big bank, and it looks like that's not the last bailout that's going to be needed, because their problems are due to the fact that they quintupled their debt in the decade following the Great Recession. And that helped pull the world out of the Great Recession. They borrowed huge amounts of money, and they spent it largely on natural resources, which basically pulled in all the iron ore and the copper and everything that was being produced in the world for a while there. And transferred a lot of money to the resource-based sectors of other countries. And so it led to economic growth, but at a big cost, which is when you borrow too much money, you suffer for it. And so China is seeing that happen now, and they really don't understand how markets work, because they're basically a top-down dictatorship to this day. They intervene all the time in the markets, and they tell companies what to do, and they direct investment resources. And so they're trying to do that now. They bail out whoever gets into trouble, and they tell sectors to make more or less of or whatever the sectors make. And they're hoping they can manage their way out of this, but that's not how markets work. They're far too complex for individual bureaucrats to manage. And so China was going to have problems just because they took on all that debt, regardless of what the trade relationship with the U.S. was. And I think this trade war makes it a little worse, but they were going to have problems regardless, and it's impossible to separate the two things. In other words, how much of their current problems are due to the trade war and how much to the debt that they took on in the past. You can't know that, but it's safe to say that the trade war didn't help and is making things worse for China, but that they were going to have problems regardless. Going forward, since everybody in their own way has taken on way too much debt, and because of that, everybody in their own way will have some kind of a financial crisis. The real question is timing and the order in which it happens. Which domino falls first? And it could be China, could be Japan, could be Europe, could be the U.S. So there's no way to know. But anywhere you look right now, you can find very serious problems. And almost all of those problems can be traced back to the amount of borrowing that went on post 2000 or so. The huge debt binge that happened in the U.S. because of the tech stock bubble in the 1990s was basically reprised all over the world after the tech stock bubble burst. Everybody just went for it and borrowed insane amounts of money, and now we have to pay a price for it. So you've got, for instance, in Germany, the biggest bank, Deutsche Bank, is imploding, and there's a question about whether that's the Lehman Brothers moment for Europe. In other words, that's the corporate bankruptcy that creates a crisis that metastasizes throughout the financial sector. We don't know whether that is, but it's a possibility. And in Japan, they have this combination of debt and demographics that looks completely unmanageable. They've borrowed way too much money, and their population is aging at an accelerating rate. They sell more adult diapers than baby diapers in Japan right now. So they're an ever-present crisis waiting to happen. And here in the U.S., it's a total mess. As we started this talk, we've got the whole political spectrum, basically, apparently, in favor of negative interest rates. So what's that going to do? So there's no way to know about the timing of this and about the specifics, but it's completely safe to say that something terrible financially is coming our way, and maybe coming soon if we all decide that the only way out of this is across the board negative interest rates, which, by the way, are already here for most of the world. Nearly 50% of the outstanding investment grade debt in the world now carries negative yields. That's incredible. That would have been thought impossible by economists of the previous generation, and now it's just the new normal. So yeah, I don't know where we end up in the next 6 months, but I think the further out you look, the worse the picture gets.
We'll have more with John Rubino when This Week in Money returns.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABN.AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYVresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Rubino. John, how is Canada's Prime Minister Justin Trudeau viewed on the world stage?
I don't know if I want to generalize, but my sense is that he's, liberals like him, conservatives don't like him, and generally he's seen as a young, well-intentioned guy. That's not always enough to get reelected, but he isn't seen as a bad person in any way by anybody, I don't think. So the only question is how effective is he? And I think that's an ideological thing. If you're a conservative, you don't want him to be effective. And if you're a liberal, maybe you wish he was a little more effective. But I don't think he is seen as much of an issue as the leaders of a lot of other countries are. Trump is somebody that is very polarizing here in the U.S. and abroad. And Angela Merkel may or may not be in charge of Germany much more. And the guy, or Macron in France, same issue. He's got a lot of trouble at home and may not be around much longer. So it's possible that Trudeau ends up being one of the veteran, the last man standing kind of political leaders out there, because he gets to stay around longer than a lot of the people who we think of as big names in the same category. But you would know more about the odds in your coming election, right? When is your next election?
October.
Of this year?
Of this year.
Oh, that's exciting.
Yeah.
Yeah. So we'll in the U.S. be paying a lot more attention to that than we have been, because we tend to notice when somebody gets elected and then promptly forget about them until the next election. That's how provincial we are down here. And I think that's probably true for most Americans about Trudeau. We know he's there. And if there's an election coming up, we'll pay attention and, form an opinion about who we think we should be in charge. And then we'll promptly forget again after the election. And, I think if you asked the average American who's in charge of Germany, they wouldn't be able to answer it. It's amazing the level of ignorance that we have about the rest of the world. And okay, this is a digression now into our foreign policy here, but the idea that we are qualified to barge around the world and invade other countries and bully governments and foment revolution and things like that is laughable when you think about how little the average American knows about any of these places. We're involved in Syria right now. We're sending more soldiers, and we're trying to overthrow the government of Venezuela. Yet, if you asked 100 Americans to find Syria on a map, maybe 2 of them could do it, and probably one of them is a Syrian immigrant. And if you ask them the same thing about Venezuela and why we're mad at Venezuela, we wouldn't be able to find it on a map, and we would not be able to tell you why we should be mad at them. And yet, our country has these really aggressive foreign policies aimed at these other countries. So it's understandable that the rest of the world is bemused by our behavior. And I'm kind of embarrassed by it. I would like it a lot more if we were semi-isolationist and we just let the world sort out its own problems. And we dealt with our own problems here at home, which are many and increasingly serious.
Are we likely on the verge of bull markets in gold and silver, given some of these problems you've talked about?
Very possibly. The real question is, why haven't we been in a bull market for gold and silver for the past 5 years? Because the imbalance between the amount of paper currency that exists in the world and the amount of gold and silver that are there to be bought up by this paper is immense. If just 1% of investable global capital flowed from treasury bonds and blue chip stocks, et cetera, into precious metals, it would send those things to the moon, because the 1% of investable global capital is an immense amount of money compared to what gold and silver there is to buy. And the idea that hasn't happened yet is bemusing to me. Why are stocks rising on this tide of liquidity when precious metals aren't. And I think it's just one of those flukes that happen in financial markets where assets don't all move at the same pace, but they eventually get to the same place, which is to say fair valuation. And so, yeah, if the move that started a couple of months ago in gold has legs, which it might, then this is a new bull market for precious metals, and it could go on for a long time and end at numbers that are really impressive, even by recent historical standards. However, bull markets don't go in a straight line. You have major corrections that shake out weak hands along the way, and the structure of the precious metals futures market is very scary right now. At least in the past, futures trading has dictated the price of gold in the U.S., which means when speculators get too excited and take big long positions in futures in gold, that tends to drive up the price of gold, but then the speculators, because they trade on momentum and emotion, tend to be wrong at big turning points, and they have to bail out when a correction starts, and that makes the correction even deeper. Well, the current structure is extremely disturbing because the speculators are about as long as they've ever been, which means they're really excited about gold. And because they tend to be wrong when they're really excited, we might have a big correction here in which the speculators get flushed out, and they have to sell their long positions or take offsetting short positions or whatever, and that pushes down the price. So it's completely possible that we have a big correction here, but in the context of an ongoing bull market. So this is a buy the dip situation, if that's the way it's going to work out, where if the speculators get flushed out of the futures market and that sends the price way down, then you want to be looking at adding to your stock or your stack of gold and silver coins, or adding to your portfolio of mining stocks, because once the speculators are flushed out, the bull market will take over again, and those things will start going back up. So this is a scary time for people who are fully invested in precious metals, and a really exciting time if you've got a lot of dry powder, and you're thinking about an entry point. The correction that is completely possible could give you a nice entry point.
How are the commitment of trader numbers looking for gold and silver?
They're extremely scary. The speculators are way over-optimistic right now, based on history. In other words, they're as long as they've ever been. And pretty much every time in the past when they've been that long, the price went down. So if that indicator still works, a correction is coming. But it's also possible that the fundamentals, which are incredibly bullish for gold and silver, are going to take over here going forward. And the money that flows in from the rest of the financial community will just swamp the futures market. So we really don't know. But if short-term history is any kind of a guide, in other words, the past 10 years, there's a danger of a correction right now. And it might be prudent to take steps to protect yourself from that.
Gold versus silver, which one do you like better and why?
Silver is extremely cheap compared to gold right now. We take about 10 times as much silver out of the ground each year as we get gold from mines. But the price of gold is about 90 times the price of silver. That's historically very high, and most times in the past when it's gotten to that point, we saw both an increase in precious metals prices and a faster increase in silver than gold. In other words, silver goes up faster than gold to bring the gold-silver ratio back down to around 40. So in terms of today's numbers, that would mean silver goes up twice as fast as gold for a while, until gold is only worth 40 times as much as silver from today's 90 times. So, and silver is really easy to buy compared to gold, because gold, an ounce of gold is $1,400 and then some. With the extra price you got to pay to the dealer. Silver, $15, $20 an ounce, depending what you decide to buy. So it's much easier to buy a pretty amount of silver that you can stack on your desk and look at than it is to buy that much gold. So silver would be the thing that you probably want to buy now if you're deciding what to buy in terms of bullion. And I don't think it's as big a deal with the mining stocks because there are very few pure silver plays out there. And if precious metals go up, gold and silver miners will just go up in general. And you don't really need to differentiate between gold and silver miners necessarily. But if you're buying physical, silver is the better buy right now.
Has the gold-silver ratio likely put in a top at 94.31?
There's no way to know in the short run what things like that are going to do, but this is historically really high, and it's very, very seldom in the past gone much higher than this for a sustained amount of time. So if history is any kind of a guide, this is a decent time to be buying silver relative to gold.
How are the seasonalities looking for gold and silver?
Well, that's what's interesting about what's happening now. This is a seasonally very weak time. Usually in June and July, Asians don't buy much gold or silver. They like to give jewelry as wedding gifts, the way we like to give cash as a store of value for a new family. And they tend to do their buying, or the jewelers tend to do the buying in anticipation of spring wedding demand later in the year. So usually the summer is a boring time for gold and silver, and to an extent a negative time. Usually prices go down a bit from May through July, let's say. This time around, prices are up nicely, which means we may be getting through the worst part of seasonality and heading into a time in September, October, November, December when seasonality starts to turn positive. And that's a relief. Maybe that'll offset some of the commitment of traders, futures contract games that are being played, and moderate the correction if we get a correction from the futures market. And if we don't get a correction from the futures market and seasonality kicks into high gear pretty soon, we could see a new up leg in gold and silver. So, on balance, there's always cross currents in markets like this. But generally, the environment is way better than it has been for years. So I think this is a good time to be optimistic about precious metals and a good time to be adding to your portfolio, that part of your portfolio. So, move some money out of treasury bonds, which you should be moving out of in any event, and into real assets like that.
Which sectors are you bullish on in the junior stocks?
Well, the juniors are a potentially spectacular sector, but also very tricky because, as Rick Reaugh likes to say, all the money in junior mining is made by 10% of the companies. Everybody else loses money, and in the aggregate, the sector loses money. So you need to be in that 10%. And I don't think that gold versus silver is that big of a deal in the junior mining sector. I think good versus bad is really the thing you need to be looking at. So you need a good source of information before you tiptoe into that market, because there's a 90% chance that if you're buying randomly, there's 90% chance you buy a loser. So you need to find people who have been at this for a while and who are good at picking the wheat from the chaff. And for instance, when Rick Reaugh does an interview and somebody asks him what his favorite stocks are, I listen. And I usually go buy some of those. And Jay Taylor's newsletter is another place I like. He specializes in exploration level companies, in other words, the smallest of the juniors. And he has found some huge winners lately. Look up Great Bear Resources, which is up from 40 cents a share to $3 and change in the past year. And that was one of Jay's big picks a year ago. So people like that are good sources of information, and they help you narrow down your list to maybe 50-50 winners and losers from 90-10 losers and winners. And that's almost all you need to do with juniors, because the winners are going to go up 1,000%. You know, they'll be 10 baggers ish, and the losers can only go down 100% to zero. So if you're half in winners and half in losers, you make a lot of money, and that's what you get with these guys who are very good at finding the winners. They're not 100% accurate, because that's impossible, but they skew the odds in your favor. And so you always want somebody like that as your advisor before you get into a sector that's this tricky and this obscure.
John, there's rumblings on the internet of the U.S. returning to a gold standard. Is that possible?
See, that's just yet another of the interesting fundamental things that are happening out there for gold and silver. Suddenly, you've got real voices in Washington talking about the gold standard, which is completely new. And that's part of what we talked about to begin with, where both the right and the left are now embracing easy money. To go to a gold standard, you would have to devalue the dollar dramatically right away. And the same guys who are talking about a gold standard are also talking about lowering interest rates from here. So a consensus is taking shape in the U.S., and it's already taken shape in most other countries, that calls for extremely easy money going forward. And the gold standard is part of that, in the sense that you would have to devalue the dollar to create a gold standard. So I just think that's one more really interesting thing. I do think we will have to go back to some kind of a commodities-based or extremely strict rules-based monetary regime at some point, just because the PhD standard, where we let these college professors determine monetary policy without any real-world experience, has turned out to be an unmitigated disaster, even though they don't know it yet. So when that blows up, we've got to do something else. And really, there's a limited set of options beyond just hiring some smart guys and telling them to do the best they can, with unlimited latitude. And probably what we'll end up doing is saying, well, okay, this gold standard thing worked for 200 years before World War I. What if we go back to that and then just make sure we don't make the mistakes that blew it up in the 1920s? So I think that'll probably be what happens. And these gold standard proponents now will be the early voices in that movement.
John, thank you so much for being on This Week in Money.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Coming up, Wolf Richter, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2 AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. I'm speaking with Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Wolf, welcome back to the show.
Thanks for having me back, Jim.
Wolf, is the Fed going to give us a big fat rate cut on July 31st?
Well, that's certainly what you read in the media everywhere has been. I mean, for the past 7 months, really, it's been just one single cacophony of rate cuts. And the Fed was supposed to cut at the May meeting, and then for sure at the June meeting, and of course it didn't cut. And people said, yeah, it's going to restart QE, and it's the so-called U-turn, quote-unquote U-turn, and that the Fed did, and the Fed really hasn't done a U-turn. It stopped its rate hikes, and it's continued its quantitative tightening. It slowed it down somewhat, but it's continuing. And every time Powell or any of the other Fed governors, when they speak, everything is immediately interpreted as a rate cut soon. So now we got the minutes yesterday from the June meeting, and they didn't cut in June. The markets expected them to cut, but they didn't. And so it looks like for the first time that the Fed is actually uncertain. And before then it was certain. It wasn't cutting. I had a rate hike bias. And it took out the rate hike bias earlier this year, and there was no real uncertainty about it. It was just going to hold. You'd be patient with its rate hikes, and then that patience now turned into, okay, we don't know what we're going to do. We're going to look at the data. And that's where we are right now. And the data is really pretty good in the United States. The stock market, which is supposed to be a forward-looking measure, is at record highs. The unemployment claims, the weekly unemployment claims are at historic lows. The unemployment rate is near historic lows. Job creation is pretty good over the past 12 months. It's been over 2 million jobs. It's very difficult to hire people. All companies are complaining about that. Retail sales, so not brick and mortar sales, but overall retail sales are pretty good. Consumers spend a lot of money on services, so that's strong. Inflation has started ticking up recently. So there's really no economic reason for the Fed to cut. And so what the Fed has been saying, or what the Fed was saying in the, which is reflected in the minutes of the last meeting, is that if the economy deteriorates from here on more than we expect, we consider rate cut, or a majority of participants will consider a rate cut. And so what we have to look at is to see if the economy really deteriorates. There's a few more big data points that will come out, including second quarter GDP and consumer spending, and some other things before the meeting. Just before the meeting, we'll get those. And if all of this spirals down, a rate cut is certainly cemented in, I think, but probably not a 50 basis point cut like everybody's been expecting. I mean, it's amazing to see the probability of a rate cut that the markets set for the June meeting, and we didn't get a rate cut. The Fed wasn't even close to cutting rates in June. And so now, the market's been saying 50 basis points cut, so that's a 0.5 percentage point cut for the July meeting. And the Fed's been out there saying, well, okay, if the economy really spirals down, we consider a rate cut. Probably not a 50 basis points cut, but we'll consider a rate cut. And if the economy holds up or strengthens, it looks to me like there's a good chance they may not cut. And, obviously, that would be a huge disappointment for the markets. June was already a disappointment, but it blew over pretty quickly. If the Fed doesn't cut in July, there'll be, there may be a tantrum, especially in the bond market. The 10-year yield in the United States has already snapped back. It was 1.95% just a few days ago. It's now at like 2.13%, so it's snapped back almost 20 basis points in no time, reflecting some of the economic strength that's not coming out in the U.S. economy. And so my personal opinion is that the Fed's undecided. The market thinks the Fed is 100% decided on a rate cut in July, and it's just a question of whether 25 basis points or 50 basis points. And I think there's a possibility that the Fed will cut 25 basis points in July, but it's not 100% decided. And if the economy, if the data that comes out until then is pretty strong, which it's not going to. GDP reading in the first quarter was blowout strong. I mean, that was unexpected. It was sort of a fluke. And so everybody expects the second quarter GDP to be lower than that. I mean, 3.1% for the United States annualized growth is, as it was in the first quarter, that is hot, for a mature economy like ours. And so we're not going to see that in the second quarter. And, if it gets to 1.5% to 2% range, I think that would meet the Fed's expectations. Now, if it drops down really low unexpectedly, that would definitely be a red cut scenario. But, I think we're going to be in the 1.5% range. And after the 3%, increase in the first quarter, that averages out to be a little bit above 2%. And that's where we've been in the past few years, really.
Isn't that the target the Fed wanted, was around a 2% inflation rate?
Well, the inflation, so it wants 2% inflation, the way it measures it. Now, I was talking about GDP, but they were talking about inflation being low, and they have a special inflation measure that doesn't really apply to real people's lives. It's the PCE without food and energy. And that runs lower than the CPI measure that is more commonly used for other things. And but that PCE core has been ticking up, and it's still a little bit below the Fed's target. It was right at the Fed's target for much of last year, and then earlier this year it dipped. And we had, as you know, in Canada, we had a second oil bust in the last few years. So we had the first one, 2014 through 16. And then we got another oil bust starting in August 2018. And so oil prices dropped a whole bunch, and that brought inflation down in a number of things. And there were some other factors involved. So that's now sort of winding itself out of the system, and inflation has been ticking up a little bit, or the way the measure that the Fed looks at, so PCE without food and energy, that rose 1.6%, but it's not too far off the 2%, and it's likely to tick higher over the next few months. And there's lots of reasons for that. There was some transitory stuff going on in addition to oil prices having dropped a whole bunch, and so the inflation is it's kind of a wild card. The Fed's really worried about it. Low inflation, consumers love low inflation. Inflation just means the purchasing power of the dollar disappears, before your eyes. But in terms of the Fed, that's its target, to try to get 2% inflation as it measures it, and it's not too far off. Having rates just to get to an inflation target is not generally used. You cut rates to get to an economic growth target, or to stimulate employment, or to accomplish some other economic things. Inflation is considered a byproduct of hot employment and hot economic activity, and that it will move up. And that connection has been pressed down a little bit, because the service inflation is very strong in the United States. It's way above 2%, and services such as healthcare, financial services, professional services, and all these they have pretty strong inflation. Where inflation is low, it's in goods, and that makes sense. I bought my first couch in 1982, and I paid for a couch in the love seat. I paid like $1,200 for it back then, and it was nice. But it's cloth and now 2 years ago we went on the internet. We bought a much nicer couch, love seat, and plus a chair, and it's really beautiful leather. It's gorgeous, and we paid about $1,000 for it, free delivery, free shipping, and that's how things are with the internet. It has brought goods prices down in many categories. $4,000 in 1985. Bought a boat anchor of a personal computer, and I had one of those. Didn't even have a hard drive, Now for $4,000, you think of the computing power you can buy, and the same with all electronic devices. These things have gotten really cheap, and that's deflationary. And internet shopping, clothing, you can buy bed sheets directly from India on the Amazon platform, and they cost a fraction of what the bed sheets cost that you would buy at a retailer locally that also buys them from India, but there's wholesalers involved and importers and all kinds of other middlemen that take out that cut plus the retailer's cut. So you have all these influences that bring down the goods inflation. And there's inflation in food. There's quite a bit of inflation in food. But the internet economy has caused prices to collapse on a number of items, in part because you have just very easy comparison shopping, and in part because you cut out all the middlemen. You starting to buy direct from manufacturers via a platform like Amazon or eBay or many of the others. And the Fed is aware of that some of the low inflation has to do with the way the economy has changed in the goods-based sector. The internet has changed how things are being sold, and that has put lots of downward pressure on prices of goods. Meanwhile, services have skyrocketed. So healthcare in the United States is, it's a national crisis. And it's gotten so expensive, and that's inflation. And rent is inflation, and everything, not just of apartments, but anything that you rent, like vehicles and other things. I mean, that's all services, and so that's the split the Fed is looking at, and I don't think goods inflation will change dramatically. It's just too competitive out there. It's a globalized economy now. We bitch about globalization all the time, but it's brought prices down for consumer goods. And, and I think the Fed is fully aware of these, and there's nothing the Fed can do, to change that. It doesn't want to change that. I mean, that's just baked in the system right now. So you want to make sure that the economy grows at an adequate rate and that, people are employed and have good jobs and get paid well. And their wage has been rising over 3% year over year for the first time, starting last year, for the first time since the financial crisis. So it was in the 1.5% to 2% range, and starting last year, it's been over 3% year over year increase in wages. So these are all signs of strength and of an economy that runs a little hotter and has more demand for labor. There's still a huge supply of labor out there, people that have left the labor force that could come back into the labor force. I mean, there's a lot of labor supply still out there. But, so this economy, in my view, is just not a rate cut economy. And, if it spirals down, but and Powell said again, it's a good place. The economy is in a good place right now. It's not, it's growing, it's doing fine. People have jobs, companies have trouble finding people, they're having to raise pay to hire. And it's all these elements. So, and I think that's what it comes down to at the next FED meeting, which will end on July 31st, is the economy, does the economy need a rate cut? And now the Fed's got another problem. The markets expect a rate cut. So if they don't get a rate cut, there may be a tantrum in the markets, and the Fed doesn't sure want a tantrum in the markets. So, they'll gradually have to talk markets down. They did a pretty good job in June when they disappointed the markets, and there was not a major tantrum. There's a little bitty tantrum, but it just blew over really quickly. And, so they may be able to walk markets back from a cliff gradually, and we'll see. And there's right now, I think there's a possibility of a 25 basis points cut. I don't think there's a big chance of a 50 basis point cut, and I think there's a pretty good chance of no cut. And that's not priced in at all. Right now, 100% probability that there will be a 25 basis points or more cut. And so we'll get, if there's no cut, there will be some disappointment out there.
We'll hear more from Wolf Richter when This Week in Money returns.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp, RMO on the TSX Venture Exchange. Rainy Mountain Royalty Corp is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Wolf Richter. Wolf, how's the year shaping up for new vehicle sales in the U.S. and Canada?
Well, the short answer is not good. In Canada, new vehicle sales during the first half are down 5.5% from the same period last year. That's the first decline for the first half since the financial crisis. And it's a pretty steep decline. It's not just a little tick down, you know, and it's a pretty steep decline, 5.5%. Last year, so a year ago, it was about flat over the first 6 months. Now we're looking at a 5.5% decline. That will take us back to, you know, 2015 levels of sales. So 2016, so it winds us back quite a bit. In the United States, in the first half, vehicle sales declined about 2.5%, but it's now, so in the year, sales peaked in 2016. So if we continue to go down at this rate, it'll be the third year in a row of declines. If my estimate is that if we continue at this pace, in the year, new vehicle sales will hit about 16.9 million vehicles. 16.9 million vehicles is what the United States sold in 1999, 20 years ago. And I was in the business until 1995. And, you know, and back then, there were some periods of declines, but the overall trend was up. And then the market peaked in 2000 and started declining, and then heading into the Great Recession, plunged in the Great Recession. Then we've had the strong recovery from the Great Recession, and now we're back where we were in 1999. And so this is you take out the Great Recession, so take out the plunge and the V-shaped recovery. It looks like 20 years of stagnation in terms of the number of vehicles sold. And this is a broader phenomenon, because what we're seeing is that the average age of vehicles on the road has now risen to 11.8 years. When I was in the business, it was under 8 years. It was 7.5 years or something like that. And back then, people were already wringing their hands over this, you know, because it was rising, and they thought, you know, customers would have to soon come out and get rid of their old clunkers and buy something new. And year after year after year, you know, the average age keeps going up. So cars are on the road longer. That doesn't mean that people drive their cars for 11.8 years. Yeah, there's a big used car market, so people are trading their vehicles. But that's the average age of the vehicle on the road in the United States this year. So, you know, that's one reason why it's hard in this market to get the total number up, you know, because people are driving their vehicles longer. Okay, so there are more people and there are more drivers. Then you have the other issue that people are driving less than they used to. So in terms of the population that is 16 years or older, so that's the driving age population. They're driving at levels that we haven't seen since the mid-1990s. And then, you know, there's due to the 17 million new vehicles being added to the fleet every year, you know, and then there are millions of vehicles that go to the salvage yard, and then there's some more vehicles that are sold to other countries. So there's this influx of new vehicles, and there's this outflux of old vehicles. And the result is that over the years, every year, the number of vehicles in the U.S. fleet, in the national fleet, has grown. And now there's 275 million vehicles in the national fleet. And even as people are driving less, and even as vehicles are getting older, there are more vehicles on the street. So when you divide that out, and I've done that, you get an average mile driven per vehicle on the road. And in 1919, that dropped sharply and dropped to 1992 levels. So this shows you that there is some big structural change going on in the industry. It's not cyclical. There's cyclicality too, the ups and downs from one year to the next, that's cyclical. But the fact that the vehicles are getting older, that people are driving less, that there are more vehicles on the road right now than ever before, and that per vehicle, the vehicles are being driven less. Now, so they last longer. They're being driven, the quality's getting better these days. They last longer just because it's better quality, but they're being driven fewer miles. And so that's what ages a vehicle is driving, not the vehicle sitting in the garage, but how many miles it's driven per year. And, and that dropped to like 11,700 miles per year per vehicle, in 1919. And it's low. It's the lowest since 1992. So, this is impossible to overcome. This is a structural change that will continue. And we have a tendency now in the United States, as you have in Canada, of new developments, new housing developments being in densely populated central areas of cities. There's a lot of money being spent on towers and on apartment towers and condo towers. And a lot of times these people don't need a car, or they drive very little. That it sits in the garage most of the time. They may walk to work or ride a bike to work or take mass transit. And this is a trend that's been going on for 10 years. I mean, there's a lot of structural changes. So we're looking at an industry that is in a really tough spot. And there's probably not a lot of chances that, that in the United States there will ever be 20 million vehicles delivered in 1 year. That 17 million level seems to be about as far as we can go over the past 20 years, and we may not even be able to hold that level. So it's a no-growth industry in the United States. Every new player that comes along, like Tesla, is taking a slice from everybody else. And so if you have a Chinese company coming in here, which eventually they will, and start selling vehicles, and they may sell them at a price point where they're successful, this will take a slice out of everyone else's sales. And Tesla has done that already. So we expect a few more newcomers, but the overall sales won't go up. And so what are car manufacturers doing? So they're going upscale so that the dollar sales will go up. So when you look on their financial statements, you see the dollar sales. And when we look at the delivery data, that's the unit sales. And the dollar sales can go up if automakers are able to switch customers into more expensive cars and raise prices. And that's exactly what's been happening. The cheaper cars have been discouraged. Americans are buying more and more pickups and SUVs and compact SUVs. They're really popular. They're a lot more expensive. They have a lot fatter profit margins, and Wall Street loves that. But the entry-level vehicles that they all used to make, they're starting to disappear. And Ford still has one, and a couple other manufacturers still have one, but they don't really advertise it. They don't push it. It's just there for the FA standards, the corporate average fuel economy standards. And what they're really advertising are the big equipment, the pickups and the SUVs and the compact SUVs. And this leaves a lot of Americans priced out of the new vehicle market. And so they can't buy. And so new vehicle sales, they switch to used, and new vehicle sales will continue to not go anywhere. This is not a growth industry at all. The growth lies only in switching people upscale and raising prices. And there's only so far you can go. If wages don't come up, at some point you're going to run out of customers as you go upscale. And the $100,000 pickup, that's the thing. That's the next thing. If you buy a crew cab, a luxury crew cab, automakers started to play with the idea of selling them for $100,000. And they're hot. Crew cabs are hot. They're big and they're hot, and but they're not for everyone. Not everybody can afford them, and that's the limit of the industry. That's the limitation, and And there's really no exit. The only chance that would have to really increase their volume is to come up with some entry-level vehicles that sell in the in the $13,000 to $15,000 neighborhood, and to really promote them. And that, Ford has one of those, but they don't promote them. They really need to promote them, and then they need to be out marketing them and advertise them and create lots of volume. Then they could get the numbers up, but the profit margins are too low if they exist at all, and there's no financial incentives for these automakers to sell cars like that, or to sell really any cars. And they're getting out of the car business. They're all plowing into the category of trucks, which is pickups, SUVs, crossovers, and vans. And that's where this industry is going.
We'll explore the used vehicle market when we return with Wolf Richter.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Wolf Richter. Wolf, how are used vehicle sales doing?
Used vehicle sales are running around 40 million per year. So you compare that to new vehicle sales, which are around 17 million per year. So the used vehicle market is far bigger than the new vehicle market. And it's backed by a very liquid wholesale market. So there are auctions in every city. And these auctions, this is where the rental cars are being sold, the lease turn-ins, and the repos, and the government vehicles, and all kinds of vehicles are sold at these auctions, and they're sold to dealers, and then dealers retail these vehicles on their lots. And this system is liquid. It works well. It functions. In addition, there is the private market where people sell to each other, and so the business is very vibrant. And the increasing share of Americans that have been pushed out of the new vehicle market because they can't afford to go upscale like the automakers are. They can't afford the average new vehicle price or transaction price in the United States is now around $35,000, and that's the average, So after incentives and everything, that's a lot of money for a lot of people, and so it really, they're priced out of this market, and so they go used vehicle, and the demand is strong. The prices are rising. The vehicles that are completely dead on the new car side, the mid-size car, they are hot on the used vehicle side. So there's demand for cars, except not at the price points that the new vehicle manufacturers want to sell them as new vehicles. So they're attractive at price points in the $10,000 range, and where you can get a nice, fairly new mid-sized car, and that's what people are doing. And they come out of the rental fleets, and they come out as lease turn-ins and from government fleets, and they have the sharpest price increases. That there's a lot of demand for these, and there's a lot of demand for 10-year-old cars that are in good shape. That's the cheap car that everybody wants, and they have seen pretty steep price increases too. In the United States, we had the cash for clunkers program after the financial crisis. That took out a whole generation of old cars, so that put a lot of pricing pressure. It was designed to stimulate new car sales, but what the side effect was, it removed a generation of used cars, of older used cars, and it pushed up prices of the remaining used cars. And we've seen that ripple through the system. And these price increases, they stuck. So used cars are pricier now than they were. quite a bit pricey, in part because the prices shot up during that period. And, so it's not as cheap as maybe it should be, but it's still cheap enough. And it is a very big market with a lot of demand. And if I were a new vehicle manufacturer, I would look at this very carefully. And maybe I'm a Chinese manufacturer, and I'm thinking, okay, so how do I crack open the door in the United States? What do I need to do? And what they would need to do is come in with a very good, low-priced, mid-sized car that is considered dead on the new vehicle side, and that would have to compete with price on used vehicles. And that's a real opening for that, I think. And that's a real vulnerability of the auto industry. The U.S. auto industry is getting out of car manufacturing. They're really focused on trucks and SUVs and crossovers, and they're shutting down their car plants. And I think that leaves them vulnerable to a shift. And I think there will be a shift at some point because there's so much demand on the used vehicle side for these cars. They're strong, they're easy to sell. They're good cars now. A 2-year-old, a 3-year-old mid-sized sedan, that you spend $9,000-$10,000 on will last you a long time. And it's not a driver that just gives your teenage son a wreck. It's a pretty nice car, and it's got all kinds of nice electronics in it and leather interior and lots of good stuff. So maybe a camera in the back and all this fancy stuff that rental cars have. These are rental cars that come out of the rental fleets, and they're not base vehicles. They're pretty well equipped vehicles, and they end up on the used car market via these auctions, and it's very good business. And it's doing pretty well this year. There's this hope that we'll get over 40 million vehicles, used vehicles. I don't think we're going to hit that, but we're going to get pretty close, I think.
Do millennials have a whole different attitude towards cars than we did at the same age?
I think it depends on where you live. So if you're a millennial and you live in the San Francisco Bay Area, particularly in one of the cities, in the core of the city, it's not in the outer parts, you're likely to not want to mess with a car. And that's in New York City. It's always been the case. In Manhattan, if you live in Manhattan, you really don't want a car. You don't need a driver's license there. And it's started to spread a little bit. In other parts, there's smaller towns like in Tulsa or in Oklahoma City or in Dallas. Dallas not a small town. I mean, it's a huge place. Houston, it's a huge place, and you're screwed without a car. You just can't operate without a car. You need a car to go to work. You need a car to go grocery shopping. You need a car to go out on dates. And it doesn't matter whether you're millennial or whatever. That's how transportation works in those cities. So that part is probably not changing as much. But in some cities that are building around a less car dependent layout, millennials and other people. I mean, boomers too. It's not just millennials. It's not generational. I mean, you have boomers move into condos that are centrally located so they don't have to mess with cars anymore. I know people like that, and it's a good thing to do. Yeah, it's a fun thing to do, not to have to mess with driving and parking. If you live in a crowded city, Vancouver, wherever it is, driving and parking is a hassle. If you can just walk or take public transportation for a little while and then walk, it's so much more relaxing and easier. So there is a big change, and I don't think it's just millennials, but those are only some cities. That's not everywhere, and we tend to generalize. But a big part of the United States it's not that way. You have to have a car, and you'll be driving a lot to just do anything at all. And whether you're millennial or not, that just hasn't changed, and it's hard to change because Dallas. It takes you. It's 150 miles across, from one end to the other, and it doesn't have a lot of transportation and the whole urban area, and so if you're there without a car, I don't know that you can function really.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Wolf Richter. And thank you for listening. If you have any questions for the show, you can send them to info@howstreet.com. Now stand by for company showcase updates from American Manganese CEO Larry Reaugh, Craig Goodwin from Naturally Splendid, and ABN Resources Jim Pettit. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, Jim, it's another show, another day, and I always enjoy them.
Larry, you've just got back some positive test results. What were they and what were you testing?
We were testing the purification, which is 3 and 4 of our pilot plant. And we got excellent results on there. We got 99.8 or 988, which is pretty high. And but we think we can do better than that. So we've got another batch that we're going to be running here soon, and another one of those big cakes you saw on our press release a week ago. But yeah, that's it's everything we've gotten has been very encouraging, and we'll be completing that, and then we'll be running a bunch of tests to file a patent on the tail end, which is stage 5. So that's a little bit different, but it's tacked on to the end of the plant, and it will eventually create savings in cost of reagents. So that's important because when commodity prices slide, those sorts of items are super important in keeping your company floating. And although we're not really concerned with any sliding in the prices. When we first looked at this, it was below where it's trading today, and cobalt and everything else was pretty much the same, although lithium was about half the price. So, and it looked robust then, and and I think we're in good shape for any further deterioration in commodity prices. But let's get back to the important thing: is the purification steps that we're taking. We want to get those as high as or better than the standards that the battery companies have. They all have different standards. And, they also have different ways of heat treating the cathode material. So it's an important item to them. And then going further on that, I'd just like to say that we've got deliveries of cathode material from 3 different areas, one in the U.S., one in Asia, and one from Europe that are going to be in the queue, and we want to get those done as quickly as possible because the work on that will tell us that, hey, we can turn this product around for you, give it back to you from cathode to cathode or from the battery grade, or we can tell you we can treat your material and, we can get high recoveries and high cathode purification. And one's a test for something we're involved in, and that will eventually be talked about. But so there's 3 in the queue right now, and there's probably some other ones back there, and not probably. There's another 3 or 4 that are unfortunately had to be pushed to the back. So it's an exciting time for us, and people have to remember that all this testing, of course, is costly, and but we've pretty much proven out that the pilot plant will do the job. Certainly, the purification can be, we think, has got room to be improved on, and that's kind of where that's at right now. We're the one thing that we've done is we've done the assessment, geochemical and geophysical work on our rare earth property, which is of some interest to some of our shareholders, and we'll have those results in a few weeks. And we'll also be doing work, and I'll be announcing when that starts, on the Rocher de Boule gold cobalt property we have up out of Hazelton this year. So there's lots on the plate, and we just keep going one step at a time. We've had lots of conference calls this week, and next week we have some very important ones, and we're just moving on. I mean, everything takes time, and but we've done things in a pretty short period of time. We've applied for patents, and we've gotten them in 13 months. The second one's in 81 days, and that was almost a record. And it shows you that nobody is using, at least I shouldn't say nobody's using, but nobody is filing any patents utilizing our patent solution.
Larry, for people new to American Manganese, what are you guys all about?
American Manganese is a critical metals company which was fortunate enough to develop a process for treating very low grades of manganese, and we were able to capitalize on that and move quickly into the cathode area for nickel, manganese, cobalt, aluminum, and this is and also for the lithium. So we've been working on that solution. We've got 2 patents, and we'll have a 3rd patent pending shortly. You can reach us check us out on our website, AmericanManganeseInc.com, or you can phone the office at 778-574-4444, or you can email me at LREAUGH@AMY.V.com.
Larry, thank you so much for the update.
You bet.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on July 12th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Craig Goodwin, CEO and co-founder of Naturally Splendid. Welcome back to the show, Craig.
Jim, thank you very much for inviting me back.
Craig, you've cranked out yet another news release. You guys are in the news a lot. What's the latest?
Well, you know what? We have been in the news a lot. This particular news release specifies our Natera Sports Byte launch, which is an exciting development for the company. This one is expanding our technology and our expertise for the athletic crowd. The formulations were actually developed by Dr. Stuart Love, who actually resides in Victoria, British Columbia. Dr. Love has an extensive background in sports nutrition, chiropractor, and he's developed a roster of professional athletes, focusing primarily in the last couple of years on golfers on the PGA Tour.
So where's this going?
Well, Jim, what we're trying to do with this is to expand our market range, not only for the everyday athlete, but this extends our product line to that experienced athlete, someone who's taking their performance to the next level. This is the beginning of supplementation that can include CBD or cannabidiol as we develop our products and as the regulations allow. There's been some interesting news on the regulatory side, Jim, and we all know the edible laws and the regulations are changing here in Canada. The news came out in June. The new regs will be out October of this year, and products available in December. But there's also other regulations and governing bodies that are advancing the CBD cause, and one of them is WADA, the World Anti-Doping Association. And they've actually removed CBD, removed cannabidiol from the restricted substance list. So now athletes are beginning to access this incredible ingredient, and we're very fortunate to have somebody like Dr. Love formulating advanced products and formulations for us, even prior to CBD. But as CBD regulations evolve, we plan to be on the forefront of that as well.
Where are you guys traded?
Well, we're traded on 3 exchanges. On the TSX Venture, our symbol is NSP. We trade in the United States under the symbol NSP.V. We trade on the Frankfurt Exchange under the symbol 50N.
Craig, are there other products that people should be aware of that Naturally Splendid does?
100%, Jim. Thank you for asking that. We have a wide range of nutritional products, and that's from the basic hemp seeds, proteins, and oils. We have a variety of protein and fruit bars. We have advanced nutraceutical products, and all of these can be found on our website, which is www.naturallysplendid.com. That one site houses all our brands, and I encourage our listeners to go there and look at our great range of products.
And if people needed more information than that, is there a phone number?
There certainly is. It's 604-673-9573. That would be for the investor relations, basically. And there's also emails if you have inquiries regarding products.
Craig, thanks a lot for the update.
Jim, thank you very much for having me today.
We've been speaking with Craig Goodwin, CEO and co-founder of Naturally Splendid. I'm Jim Goddard. Our conversation took place on July 10th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on howstreet.com.
I'm Jim Goddard. I'm speaking with Craig Goodwin. He's the president and co-founder of Naturally Splendid. Welcome back to the show, Craig.
Thank you, Jim. It's good to be back so soon.
Craig, Naturally Splendid had a major news release today about an acquisition. What can you tell us about it?
The pending acquisition is for AlternaMedz Canada Holdings, an Ontario-based company that is in a confirmation of readiness stage before Health Canada to obtain their cultivation and processing permits in the cannabis industry.
What are the benefits of acquiring AlternaMedz?
The benefits are many, Jim. The combination of licenses within AlternaMedz really solidifies our position in the upcoming edible markets. But there are some specific opportunities as well. That is expansion into the CBD-infused products. It also creates a vertically integrated edible products opportunity. And as importantly, or maybe even more importantly, accelerates our licensing process. So that combination of licenses that we will be obtaining and the acceleration of licenses, I think, is key given the time frame of the new regulations coming into play in Canada.
How does this complement your ongoing food manufacturing strategy?
This strategy has been developed over the last few years, Jim. We've spotted early on that we wanted to be more than just a commodity, whether that was a commodity in hemp or a commodity in CBD. We saw a need to create value-added products to get out of the Me Too category. So the acquisition of a license such as this, which will allow us to develop CBD-infused foods, is really the culmination of 2 years of work. It takes the best of our processing expertise in the area of food manufacturing. It leverages that with our hemp expertise we've gained over the last 10 years, and of course, the extraction expertise that we have embedded in the company. So it's that three-pronged approach that really creates a unique and advantageous position for Naturally Splendid.
Can you also tell us about your Keto Life Keto Bars?
We launched those about 4 months ago now. The first 90 days, we hit almost 1,000 stores for retail distribution. It's that same methodology, Jim, that being able to spot a market, create product internally, we do our own branding, our own marketing, and of course our own distribution. So it's this expertise that we've gained in the food industry that's going to allow us to penetrate the edible markets. What we've seen with our clients, Jim, is that there's lots of cannabis and extraction opportunities out there, but food companies want to work with food companies. And so our expertise and our ease of working in this environment, one that's highly regulated, really gives our clients who are producing, call it standard food products, it gives them a great deal of confidence as we enter this new world of infused cannabis and in our case, infused CBD products. So our expertise gained over the last decade manufacturing food gives our clients the greatest level of confidence that we're going to be able to produce cannabis or CBD-infused edibles and be able to reach all the regulatory requirements that are necessary in this highly regulated area.
Now, how does this affect your ongoing processor's license application at your Pitt Meadows, BC facility?
Well, actually, it accelerates it. We have gone through 2 readings at Pitt Meadows Council now to get our processing license. Our 3rd reading is coming up very quickly. But the ability to be able to present a confirmation of readiness stage application as part of our presentation really leverages the fact that we are experts in this area and that Health Canada has already approved our SOPs and our security systems. So being able to take what we've learned in the application with Health Canada through AlternaMedz and apply that to our application here locally in Pitt Meadows is bound to accelerate the final approval for that.
You've announced a private placement along with the AlternaMedz acquisition. Can you tell us how that's working out?
The acquisition of AlternaMedz was an all-share transaction, but of course the final build-out will require some additional capital. So we've gone to the market with a private placement at 14 cents, and there's a half warrant at 21. We're raising $2.5 million, and that is more than sufficient to build out our facility. As most people will recall, we've already purchased over $1 million of extraction equipment through our partners Wahupta and their wholly owned subsidiary Current Technologies. So the $2.5 million we're raising through the private placement will help us get to the operational stage of our facility in Ontario, as well as continue the build-out at our Pitt Meadows facility.
Where are you guys traded, under what symbols, and how can people get more information?
Well, we are listed on 3 exchanges. We are on the TSX Venture under the symbol NSP. We also trade OTCQB in the United States, and that symbol is NSPDF. And we trade in Frankfurt under the symbol 50N. And if you're looking for information, you can actually contact Brent Rusin at 604-673-9573, or you can go to our website, which is www.naturallysplendid.com. info@naturallysplendid is the best place to find information as far as an investment in our company.
Craig, good chatting again.
It's always good talking to you, Jim. Thank you very much for making the time today.
I've been speaking with Craig Goodwin, president and co-founder of Naturally Splendid. I'm Jim Goddard. Our conversation took place on July 8th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of Howe Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Jim Pettit, CEO and President of AMY.V Resources. Welcome back to the show, Jim.
Thanks, Jim.
You've just put out another news release, Busy Times in the Golden Triangle?
Yeah, it's starting to, we're winding up right now. We just put out a news release the other day that we are starting. We have started. Over the last weekend, I think it was Friday, we're probably on our second hole now. But I've noticed a number of news releases lately where there's other companies are all starting up. So it's going to be busy. I think there's going to be more people drilling there this year than there was certainly last year.
And taking a look at what's going on this year, what kind of prospects are you looking at?
Well, we've had the benefit of in the off season, 3D modeling all the drilling. We 45 holes. We have the advantage now of 3D modeling the whole north boundary zone. We did an airborne survey, a month or so ago, and we've got that data. We plugged it in, and it's giving us a better picture of deeper seated structures, what could be influencing these pockets of high grade that we've been hitting, giving us some, we're developing our own theories now on the north boundary zone to go back in and test a few more areas with this knowledge, and then going forward from there, new pads and new locations based on what we see in the geophysics that we just did, and how that ties into the south boundary zone, because that's looking pretty good. We always kind of felt that the 3 holes we drilled there kind of were just beside it, or we just missed by a little bit, but they were good enough to get our attention. And we want to go back and prove that, and there's a few more targets as we head south. And then at the end of the year, we want to end up, at the end of the season, down in the forest property, which is down in the very southern part of our property, which is, we've always kind of highlighted a big target there we want to get to, and I think we'll spend a little time there towards the end of the season. We've also just stopped drilling on the Justin property. We spent an extra month drilling this year, and to extend our season of drilling, we added a month up in the Yukon on the Justin property. And we had a diamond drilled 4 holes, and the RAB drilled 17 holes, and the RAB was primarily drilled on the Lost Ace zone, and the diamond drills on the old POW zone that we had uncovered in 2012, and we have a theory up there that the higher grade Lost Ace zone could be overprinting on and remobilize some gold into the POW zone, which is a younger intrusion-related gold system. And we've got all the assays in the lab in Whitehorse, and we're waiting on results. And that should be any time now.
For people new to AMY.V Resources, what are you all about?
We're all about gold. We look for high-grade gold. We're in an area that we think we can find high-grade gold. We have been finding high-grade gold the last few seasons. We're working on trying to tie that all together now and get a better understanding of what the controls are, which we think we're now on to something because of the geophysics are going to help us out there, as well as the 3D modeling. But it's all gold. That's what we're after.
Where can people get more information, and where are you traded?
We are, you can go to the website, ABNresources.com, and as far as trading, we're in the OTCQB ABN.AF is the symbol. Frankfurt is E2L2, and in Canada, we're on the Venture Exchange. That's ABN.V.
Jim, thanks a lot for the update.
You bet. Thanks a lot, Jim.
I've been speaking with Jim Pettit, CEO and President of AMY.V Resources. I'm Jim Goddard. Our conversation took place on July 12th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.